In the first 10 years of investing, you feel like you're making no progress.
Yeah.
Like all your progress is really dependent on how much capital you're contributing to the holding costs of property or putting into a share portfolio. The returns are nothing in the first 10 years. It depends on the numbers you're investing in. It's only typically after that first 10 years that you really start to see the benefit of compounding. That's why experienced investors are much better through periods of volatility because they've seen it all before. And that's why all the young investors or first-time investors probably make most of the mistakes. It's okay. Like when you start out your journey, you know you're doing the right thing, even though you don't see the results yet.
Yeah.
And it's about having the confidence and knowing that that's the correct expectation, that it's not a signal you're doing anything wrong necessarily. It's just compounding hasn't kicked in yet.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to Perth Property Insider. I'm your host, Jared Mann, and today I'm going into a topic that takes us back to first principles on how wealth is actually built. And I've got my good friend, financial advisor, owner of Pro Solution Private Clients and the fabulous podcast I listen to all the time, Investopoly. It's Stuart Wemyss. Thanks for joining us again, Stuart.
Hey, Jared. Lovely to be back with you. Thanks for the invite.
Well, there's more and more noise at the moment. I think, the internet technology, there's more information out there than ever, but it can be more distracting than ever. And I think in the investment space as well, over the last sort of 5 years, there's more and more shiny investment options to take our attention away as well. Is that what you see and hear through your clients?
There's always shiny objects trying to distract us, I think, from making the wrong decisions or short-term based decisions. And really success lies in the discipline of following the evidence, really. And the unfortunate thing, though, particularly with social media, is that it's not very exciting. Like you can post about making good, sensible, long-term decisions, but that's going to make for a really boring video, of course. And it's not going to cut through. Whereas if I'm going to talk about, how you can make $1 million off Bitcoin over the next 3 months, of course, that's going to garnish a lot more attention. That's kind of the sad thing is that, there is a lot of attention grabbing stuff out there. But I guess in a way, compared to maybe previous decades, in a way, it's kind of good because people will eventually get fatigued. They'll get fatigued by following or chasing or responding to these shiny objects. And then maybe at that point, they sort of reflect back and go, well, maybe there's a better way. Maybe this hasn't worked for me. Maybe there's a better way. So who knows? It could work as an advantage. But I think a lot more people would be far wealthier if they just stick to the true tried and tested. And it's not just about my opinion. This is what works or this is the way you should go. It's all evidence-based, it's all common sense, all basic logic. As I said, it might not be particularly exciting, but to be honest, I actually do get excited about building long-term wealth. I'm excited about the fact that in 10 years from now, my financial position will be much stronger than it is today. Now, I've got to wait the 10 years. There's a bit of delayed gratification in there, but, I guess it's what excites you.
Well, I can speak from experience when I talk about being very busy and chasing the latest fad and feeling like you're super active in what you're doing. And that's how I originally came to seek you out and really get grounded in your principles. And that's how, I think we've worked together now for 4 or 5 years with you as being my personal financial planner and advisor. So I like having you to keep me on the straight and narrow a bit. Whenever I get a crazy idea, I send it to you and it gives you some fuel for your next podcast that you create.
Yeah, sometimes I pick on clients. In terms of that's where I get the idea.
The inspiration, yeah.
Mean and I recorded one this week about that. But Russell, a investment firm, actually produces and has done for a number of years. They try to quantify the value of advice and they look at things like tax drag and fees and these sorts of things. But according to their research, and take it with a grain of salt, they're a fund manager trying to sell financial advisors. Of course, that's an upstream product for them. Of course, there's a vested interest in doing that. So take it with a grain of salt. But they do put the largest bit of value on the behavioural finance characteristics. And I think that's if that's only one thing that a financial advisor does is stop you from making mistakes, that's incredibly valued by itself. You don't need to get a lot right as long as you don't completely mess anything up. Do you know what I mean? You can invest in an ETF for the next 30 years. It might not be the perfect ETF, but as long as it's pretty good, you're going to get some excellent results. So I don't think it's not about perfection, and it's not about the perfection around execution. It's also, a lot of it has to do with just avoiding making silly mistakes.
Yeah. Well, that reminds me of one of Warren Buffett's sayings. Number one rule of money or something is don't lose money. So.
Yeah, that's right. And don't lose time, because, money you could always make back again. But if you spend the next decade in pursuing the wrong investment strategy, that's cost you time. And you can't replicate that time. And as we'll talk about today, it's a very important ingredient in terms of building wealth.
So let's go back to first principles then and start to unpack this. And I think this will be a great reminder even for those of us that have been investing for decades and then those starting out. Why not ground everything in principles, and then it becomes very easy to start making decisions.
Yeah, and they're easy. Sometimes these principles are very simple. They're not necessarily easy in terms of easy to stick to and always easy to apply in every single market, but they're very simple. And the risk is that when we are faced with something that is, so simply articulated, sometimes we underestimate its value. And I don't think we can do that. I think it's really useful for me personally, for the advisors in our business, for clients to constantly kind of revisit, what are the key levers here that I need to be pulling or looking at as an investor that are going to contribute the most to my long-term success. And those things don't change, but with all the noise and all it's natural to worry about things like, well, I'll wake up tomorrow, what would have Trump done overnight? Or what about if they change CGT discount in Australia? And all these there's always these sorts of, nothing is ever static, but it's always good to come back to these first principles, I think, even though, and I think what I'm encouraging is don't discount them just because they seem relatively simple. They're incredibly valuable and as a result, very important.
Well, you're not going to be giving us any amazing predictions or secret strategies today, Ben?
Yeah, I think it's a secret strategy because most people don't follow it. Most people make the same repetitive mistakes, which will be the inverse to what we'll talk about today. But so to me, it is a bit of a secret because it wouldn't be a secret if 80% of Australians were following it, but they're not. And so I think if you can sort of adopt a very simple formula to building wealth and you can stick to it, it definitely is the secret sauce.
So let's unpack this wealth equation that you have and pull apart the parts to it, because as you say, in the simplicity, when you first hear it, it's like, oh, well, that's obvious, but when you actually unpack each of the key components and then you start to ask yourself, how well am I actually doing this part of it? That's where you can really start to, leverage and improve your investing, I think.
Yeah, definitely. So the wealth equation is really, there's 3 ingredients to the equation, and you multiply each of those 3 by themselves. So, firstly, the first observation is each of those 3 ingredients are equally important. And there's a multiplier effect here. So if you get all 3 right, there's a huge multiplier effect. If you don't get one right and you get the other 2 right, it really destroys the equation. You go from a large number to a very small number in terms of wealth accumulated. So really the wealth formula is annual surplus cash flow, investable surplus cash flow, multiplied by investment efficiency and multiplied by time. And so, if you're investing a lot, investing it well, and you stick with it over the longer term, that's really the simplest answer to building a lot of wealth over your lifetime and being in a situation most likely of having more money than you'll ever need, which is, what we all dream of.
Well, let's unpack this. So maybe starting with surplus cash flow. Is it simple, but sometimes it's easier said than done, Stu?
Yeah, that's right. And the thing with cash flow is it's always changing. And they're really different in terms of what we're spending our money on, what it's costing. I mean, we kind of need to think about last 5 or 6, 7 years to reflect on how the certain costs in our life have changed so substantially. And then also on the income side, that's changing as well. I mean, it can move positive both in positive and negative directions. So we're dealing with something that's really dynamic. The other challenge, the other mental challenge around cash flow is twofold. Firstly, we're dealing with a lot of small transactions typically. I mean, we've got some big numbers in there, mortgage repayments, private school fees, these sorts of things. But for the most part, there are a lot of small transactions. And mentally, it's very difficult to get a head around that on an aggregate level. So I might ask myself, like, how much do I spend on, I don't know, lunches or coffees or these sorts of things over the course of a year? And if you asked most people in Australia, they would take a guess, and their guess would be wildly wrong. And it's not the consistency. There's no consistency around it in terms of. I say it's wildly wrong. They're either overestimating or underestimating. It can go in either direction. So I'm not suggesting that people are always underestimating. It's just the fact they don't know, and that's okay because it's difficult. It's impossible to know. And the way I look at sort of cash flow is just try and automate it as much as possible. So, the problem with going on a diet is that you've got to, one of the ideas is count your calories and have a calorie deficit every day. And that sounds good, but no one's ever going to do that for the rest of their life. I mean, certainly I'm not going to. And I don't think most people will. So it's about automation and systemization with respect to cash flow as well. No one wants to feel like they're on a budget for the rest of their life. No one wants to feel like, and that was the second sort of mental challenge with managing cash flow is that budgeting does have bad connotations. It has connotations of now I'm not going to have any more fun or I can't spend on the things that I really enjoy. The reality is that we shouldn't trim on the things that we really enjoy. The reality is for most people, there's a handful of things that give them a lot of enjoyment, whether it's playing some certain sport. For me, it's buying wine. For other people, it could be travel. These sorts of things that add a lot of utility, a lot of enjoyment. And they're the things, we need to track how much we're spending because it's easy to overspend in those categories. But by no means do I suggest people start sort of trimming back or at least eliminating in totality those sorts of expenses because wealth building is a journey and we've got to enjoy that journey. Who knows how long we're going to be on this earth for. But the reality is what we want to do is eliminate waste. And waste, by my definition, are expenses that aren't actually adding anything to your standard of living. It could be that Netflix subscription that you actually never watch, for instance. And so if you cancel Netflix, you're not going to, if you never watch it, you're not going to miss it. They're the sorts of things. And again, if I come back to the transactional challenge, that the problem is there's lots of little things like that. That then add up to be, 10, can be $15,000, $20,000 a year. And so if we find where that wastage is, we stop that wastage and we redirect it into our investments, we get it's almost like a free lunch because, we're not suffering from a lifestyle perspective and we're being able to build our wealth. So as I said, Jared, it's really about systemization. There's a couple of things we can do to systemize our and automate our cash flow management. The first one is pay yourself first. So really you've got to work out, okay, this year, how much do I want to contribute towards building wealth? And when I say building wealth, that could be, doing a variety of different things, extra loan repayments, additional super contributions, go out and buy an investment property and fund that negative cash flow of the property, invest in the share market. But whatever it is, whatever your plan dictates, is just what amount am I contributing to my financial future? And once you've determined what that amount is, pay yourself first. When the money comes into your account from your salary or wage or however you earn income, make sure you carve that amount off first. And that way, it's like the principle of invest first, spend what is left over.
Yeah.
And prioritize the most important thing first. And then my tip for automating, just better cash flow management and eliminating waste, which is the key thing. The reality is most people don't purposely waste money. It's just about unconscious spending. And one of the best examples of conscious spending is holidays. We tend to sort of think about holidays quite deeply. We talk about it with our spouse or friends, whoever we're going on that holiday with. We then really plan it out, how we're going to get there, what's the accommodation going to look like. That's a good example of conscious expenditure that tends to deliver a lot of utility, a lot of pleasure. If we could approach every single expense like that, then it would be perfect. There would be no wastage. But of course, that's ridiculous. You're not going to sit there out the front of a coffee shop thinking about whether you're going to buy a coffee for the next 15 minutes. So that's just not realistic. So then the best way is to quarantine discretionary and non-discretionary expenses. So you can't really overspend on non-discretionary expenses like utilities and the mortgage and bills and school fees and insurance, those sorts of things. You can't overspend. They are what they are. You should sanity checked in terms of making sure that they're competitive, probably at least annually. But apart from that, they are what they are. It's all the discretionary stuff that you can overspend on: restaurants, eating out, going to supermarkets, buying takeaway coffees, these sorts of things. So as I said, you don't want to go put yourself on a financial diet because that's just too much hard work. So what I suggest then is work out how much have you been spending on those things and how much are you comfortable spending on all those things, all the discretionary items, and then quarantine all those expenses in one account. And so, for instance, you might transfer $5,000 a month into this discretionary account, and everything you buy that's discretionary goes through that account. That way, if you're looking at every month and you're halfway through the month and there's hardly any money left, you've overspent. And that's going to happen sometimes. Expenses come up. They're unavoidable. It happens. But if it's happening every single month, you need to start making more deliberate decisions. So that way we don't have to monitor. All we're doing is monitoring at the aggregate rather than the individual level. And that's something that it's a strategy that a lot of my clients have used, and the success rate is 100%. No one that has used it has stopped using it, nor no one has used it that didn't find it beneficial.
Yep.
And ironically, I think we've become unconsciously more conscious about expenditure. So sometimes we think, oh no, I'm not going to do that. I'm not going to buy that coffee. I'll make one when I arrive in the office or something like that. Just because you're a little bit, and again, it's our own personal choice, like rather than it's imposed upon us. But I find that people become much better at managing cash flows. So really, the two things are pay yourself first, and just focus on eliminating waste by using that two-account structure.
Well, I love that system. It's exactly what we do. And we've run it from the times that we were first together as a couple, and we had very little money to show for it. And there was very lean times when my wife was on maternity leave, and, we had to really look at every single expense where it was going. And then it's nice to keep the same format even when you get your extra pay increases. Then you can just increase your allocation that you're sending towards investment and leave the others pretty much the same, because we've worked out that those extra little entertainment things don't actually, improve our overall life all that much. I'd rather take a bit nicer holiday per year and chunk some money into that, and then chunk the rest into my investment allocation. And then that way you're getting a disproportionate spread to this wealth equation then. So,
yeah, that's right. And you bring up a really good point, Jared. There's no level of income where this doesn't become necessary. So I've got some clients that earn several millions dollars a year, and they still need to do this. And I've had some clients like that when they just go, well, I don't know where my money's going. And literally it will just go. There's no level of income where you think, I don't need to worry about expenses. There's always going to be money in the bank. But you won't believe it. But, one day you're spending $100,000 a year, and a few years later that's 300, and then it's 500. And you think, like, my life hasn't really improved that much. That is typically the common comment that I get. I've worked out I'm spending 300 grand a year, but we don't really go out. We don't really buy expensive clothes. And money will just disappear if you don't take control of it. And just having that automated process, I think, is much better because it's something you can stick with for the rest of your life, regardless of your income size. And I love
the automation of it. You can just put it in place. You can set and forget, and it operates in the background. So nice.
Yep.
All right. Well, what's the next part of this wealth equation? Because let's say we've got a bit of money that we're allocating. It's set. It's consistent. Now we need to sort of think about what are we going to do with it?
Yeah, investment efficiency is the next part of the equation. And really it's about making sure, the best way I could describe it is making sure your money works really hard for you. And that's really what of course you want it to do. You want to, the first part is the cash flow, contribute that money into the investment, make it work really hard for you for as long as possible, which is the third part, is the length of time. So how do we make it work really hard for us? So there's a few different dynamics there we need to think about. The first one is, what are we investing in and what are the components of return? So quite often, people start thinking about, should I invest in the share market or should I go and buy an investment property? And that's typically, what most people sort of faced with.
A good question to ask.
Yeah. And when you look at long-term returns, like when you look at long-term returns in Australia with a direct residential property, if you look at the ASX, if you look at really almost any index, whether it's a European index, a global or a US index, over the last 4 decades, the results are about the same, really surprisingly close together, about 10% per annum return.
10%.
Yeah, in terms of income and capital gains, capital growth. So you on a long-term basis, you go, well, they're all pretty good, right? But the difference is the split between income and capital growth. And that's the most important thing to understand, because if we are at the beginning of our investment journey, our goal is to benefit from compounding as much as we possibly can, which we'll talk about in the third element. But the best way to compound returns is to pay as few of tax and fees on an annual basis. And we know that if we obviously pay tax on income every year, but the benefit of having capital growth as return, of course, we don't pay tax on it until we sell that asset. And so essentially, whilst there's this unrealized taxation liability that's accumulating against my investments, I'm not paying for it from a cash flow perspective. So in a way, I'm earning a return on that tax liability, because I'm reinvesting it. And that's the best way to build wealth. The more wealth you keep, the more of the return you keep, the faster it is to build wealth. So for people that are just starting out, and I would argue almost anyone at any stage of life, it's really about investing in assets that are going to provide most of their return in growth rather than realized income. And the best 2 asset classes for that are property, particularly property because it allows you to leverage. So particularly if you're starting out, leverage is going to be a really useful tool to build more wealth over the longer run. But also the international share market has a good split between income and capital growth as well. So even if we're investing in a portfolio, and I just had a look at our last 3 or 4 years of returns, Jared, in our regular investing portfolios, the return at about 13% per annum. The income part of that return was 1%. So even when you go and construct a portfolio, what you want to try and do is minimize the income. Well, what you want to try and do is maximize the overall return at the same time as trying to minimize the income portion of that return, because I'm only paying tax on 1% each year. That's not very much.
Yep.
And that 12% gets to compound and has been compounding and will compound for many years.
When you're in your growth phase as well, let's say you increase the income you were getting and from 1% to 3 or 4%, that's probably not going to change your world at the moment. You've got your other income that you're using. You're going to pay a lot of extra tax on that because it's, being added on top of your wage income, your other income from rentals and other properties and stuff. So, you end up not being left with that much of it. And that's why you're saying it's not getting a chance to compound without being taxed. So
yeah, it's not efficient. Even if I've made the right decision in terms of, hey, I've got myself an investment that above line pre-tax level is delivering me a great return, at a after-tax level, it's not efficient. And that's what we really want, is more of our return left to compound. There's some other elements that go towards it. Of course, fees and costs are an important consideration. So that's really, but if you're employing a sort of low-cost index passive approach towards investing in the share market, for instance, well, you're going to minimize fees anyway. Our average weighted cost across our portfolio is about 0.3%, a third of a percent, I should say. So they're going to be pretty low anyway. The only caution I would provide with respect to cost, and particularly share investing, is the absolute lowest cost option isn't always the best option. So sometimes it is in some markets and some market conditions, but typically you'll find traditional market cap indexing to be really low cost. And that's okay in some markets, but you wouldn't use it in every single market all the time. So it's good to be cost conscious, but at the end of the day, what you want is the highest return after fees. So if paying a slightly higher fee gets you a much higher return, then of course, in the long run, that's going to be good as well. And then finally, in terms of investment efficiency, as Warren Buffett says, don't unnecessarily interrupt compounding. So that's all the behavioural sort of stuff that we spoke about at the beginning of today's episode, which is, reacting to market volatility, overreacting to, a good one more recently was the Section 296 tax, the tax on super balances greater than $3 million. You had people last year pulling money out of super, thinking that they were going to pay tax on unrealised gains. Now, we know towards the end of last year, they changed their stance on that. So overreacting to things just because of changes, if we do see a change in the CGT discount, it doesn't necessarily mean you need to change. And quite often as human beings, we feel like if something changes and we don't react or we don't do something, it feels like it's doing nothing. But in fact, doing nothing quite often is in fact the best thing to do and the right thing to do. Now, I'm not saying ignore everything and stay the course and you never need to react. Of course, you might need to play at the margins, or sometimes you might need to make some wholesale changes. But I'm just saying most people react when they don't really need to or they really shouldn't. And that really destroys, the efficiency of those returns, because if you go and sell an investment, all of a sudden, what we're trying to do is pick an investment that's going to pay us a lot in terms of compounding capital growth because we don't want to pay tax on it. And if you go and change that investment, you're going to have to go pay that tax. So it doesn't make a whole lot of sense.
Yeah. And is there any other sort of behavior things to consider? Because from what I've seen, this is where it throws investors off massively. You can have a lot of other things right. And if you don't get this area right, then there's a lot of self-sabotage that can come and, ultimately the wealth equation falls apart.
Yeah, I think we're just got to understand what are the two emotional drivers with respect to financial decisions. And they're present with everyone. Even as financial advisors, we experience them from time to time as well. The last thing we want to do is deliver a bad result to a client. Of course, we come to work to feel good about what we do. So it's you get better at it in terms of divorcing or separating emotion from decisions, but everyone is open to it. And you've always got to just, in the front of your mind, remind yourself that a lot of decisions are either driven by fear or greed. And so it's just about self-checking yourself and asking yourself, am I making this decision because I'm over fearful? Or am I making this decision because I'm being too greedy? So being too greedy can come in the form of, chasing short-term returns, chasing something that looks very promising. And that tends to be a big red flag, right? If someone comes and taps me on the shoulder and says, why don't you put some client money over here? We promise 15% returns over the next 3 years. I'm already kind of tuned out. That's a sales pitch rather than investment advice. And being too fearful, that's really reacting to, well, I don't feel like investing now. So sometimes we get clients that might just go, oh, everything seems so risky. Trump's all over the place. Now's not the right time. That is almost never the right answer. It's not a black or white decision. It's maybe how much, right? So if you think, I'm a little bit concerned now, instead of investing $5,000 a month of your surplus, maybe bring it down to 3, right? But don't bring it down to 0, because the regularity and discipline of investing over a long period of time is the key feature. It's not about the timing. I've done studies on this. It's not about whether you pick the best month in that year, the worst month in that, the best day of the month, the worst day of the month, makes no difference. It's what makes the difference is being disciplined about it. So I think that's what we need to check in ourselves. Are we acting from greed, or are we driven by fear? And if the answer is to either of those two things, chances are you might be making a mistake.
There's a few other principles that I like to think about as well, like what is speculation versus what is investing? So can you riff on that a bit? Because a lot of what people talk to me about and ask me about, my brain just immediately goes, this is speculation, like warning bells are ringing. But, and people talk about it as if it is investing. So that's where it can be confusing.
Yeah, look, my view is there's 3 ways you can make money. And if you think about it like 3 intersecting circles, like a Venn diagram, one of those circles is business, one is speculation, and one is investing. And I think if you choose either 3 of those options or all 3 of those options, it's fine. It is what it is. But just be really honest with yourself about what it is you're doing.
Right.
And the challenge is that sometimes they have characteristics of both. And that's why it's a Venn diagram that kind of overlaps. So a good example would be small scale property development. That's closer to a business than it is pure investing. So it sits somewhere in between. Depending on what you're doing, it might be closer to business than investing, but you are certainly moving away from pure investing. And remember, pure investing is about my money working as hard for me, harder than I worked for it, I should say. So really what I want is, here's my money. I come back in 20 or 30 years and now my money's grown and I don't have any personal exertion towards that. Like, it doesn't require me. That's pure investing. Speculation could be, I'm going to buy a property in this location that doesn't have strong fundamentals, but I think the land will be rezoned and I'm going to make a huge capital gain. That's speculation. That's not really property investing, but people might come, I'm a property investor, but no, you're not. You're a speculator. Pure investing is really about trying to achieve the highest return for lowest risk. And the best way that you can reduce risk is increase your probability of achieving your benchmark return. So if you earn 7.2% compounding on average, you won't get it every year, but on average over a long period of time, your assets will double every 10 years. For most people, that's all they need. They invest like that for 20 years or 30 years, they're off to the races. They've got enough money. Now, let's try and aim for more than 7%, but let's just go 7%. So then the question is, what is the lowest risk I can take, the lowest risk investment opportunity that I can take that is going to guarantee me at least 7%? I mean, there's no guarantees, but, give me a high probability of achieving 7%. And the answer to that is adopt an approach that's got an overwhelming body of evidence that demonstrates that if you apply these rules to this asset class, this is what the returns were. So, for example, if I'm buying investment grade property, something with a high land value component in a location where there's a finite supply, a fixed supply, and growing excessive demand, if I look at areas like that throughout Australia and Australia's capital cities, I'll probably determine that I can get maybe 1 to 2% more than what the median house price has done in that location. That's the evidence. So then my idea then is, apply those rules. There's 40 years, 45 years of evidence and data behind those rules actually working. Now, here's the kicker though. They won't work every year and they won't work every period. What they will do is they'll work over the next 10, 20, 30 years. There's going to be times like now at the moment, for example, that lower end, lower value properties are actually outperforming higher value properties. And that's unusual. That's not going to persist forever. But we're in this market. It is what it is. So that's where the challenge comes, Jared, in terms of this efficiency, is sticking to something that's tried and tested, particularly if when you're starting out, the current backdrop is it's not working at the moment. That's when it becomes really challenging. But ultimately, from my perspective, is if there's a whole body of evidence that says taking this approach works, and I take the approach, to my mind, there's no guarantees with investing, but it certainly reduces a lot of the risk compared to maybe invest in this. There's no evidence. We think it's going to work. Of course, you've never seen a bad prediction. We think it's going to work, but there's no evidence behind it. You're really throwing darts at a dartboard. That's speculation in my view.
Well, I think that's a nice place to end things on, actually. So thank you so much for coming on the show today. Did you have any final remarks, I guess, to bring all this together for us on how wealth is actually built, just to summarize?
Yeah, definitely. I mean, the last part of the equation is time.
Yes.
Which we haven't touched on, and it's an important one. I mean, the challenge with time is that there's delayed gratification involved. But the best decision that the best question I can ask myself at any point in time is, what decision could I make today, or what set of decisions could I make in 2026? So in 2036, I'll look back at those decisions and go, that was a great outcome. So what can I do today? So in 10 years' time or more or longer, hopefully longer, I'm much better off. The benefit of framing questions like that, as opposed to which asset class will outperform this year or the next 2 years, the benefit of framing the question like that is it forces you to think long term. And in the short run, sentiment drives markets. In the long run, fundamentals drive markets. So by thinking longer term, you're forced to focus on those fundamentals. And it's really important to really understand kind of the distribution of growth too, how it happens.
Oh, yeah.
So, if you get a property, $1 million property, and it grows at 7.2%, so doubles every year, over a 30-year period, it's going to double 3 times, sorry. So $1 million property will then be 2, 4, and then 8. So another $7 million of equity in that property. But it's the distribution of those returns that's important to understand. So in the first decade of that 7 million, you only get 15%. Same property, same average growth rate, same holding costs, all those sorts of things. Whereas in the final decade, so year 20 to 30, 60% of that $7 million happens. So, that's where compounding really kicks in. And so the challenge then is to pick an asset that's going to give you the highest average return over the next 20 or 30 years. That's hard to do. Actually, it's not hard to do because you can focus on the evidence-based approach, but it's hard to take that approach because it feels like, I've got to wait a long time for the results. And that's why I said at the beginning, this formula is simple to understand, but it's not easy necessarily to implement. But it's all just based on basic maths, basic logic. It's not my opinion. It can be proven and disproven in terms of demonstrate why people have failed to build wealth, for instance. But time is a very important characteristics. And knowing that, then it makes it's even more important to make the right decision from the outset. So which property I buy, which ETF I buy in 2026 is so important, because if I get it right and I hang on to that asset for the next 30 years, I'll be off to the races. But if I get it wrong and hang on to it the next 30 years, I'm going to miss out on a lot of returns and I'm not going to get that 30 years back. So I don't want to create a lot of anxiety around these choices, but it's really just understanding the components that's like Warren Buffett says, my favorite holding period is forever, and buy a stock that you'd be happy to hold forever. And the whole idea around that was don't unnecessarily interrupt compounding capital growth, because compounding, it's hard to get our head around. If I said in the 80s, a single-fronted Victorian house in Hawthorne in Melbourne would be worth, $1.5–2 million today. At the time, they would have been selling for $80,000. Someone would have gone, $1.5–2 million would have bought you the best property in Toorak. So it seems so incomprehensible that these things compound in this way, except for the fact that they've done it for many decades. And so it's really understanding the benefits of that compounding. And that's why all three bits of the formula, Jared, is so important, because they do have a massive multiplier effect. But at least it allows us to understand what are the key components I need to get right in order to build a lot of wealth over the long run.
No, well, I'm glad we got that last part in of time. It seems to be the powerful multiplying effect when you've got those other two things right. And it boggles my mind when I see projections. In a way, it helps me get also comfortable with having that future wealth, seeing it and becoming comfortable with it along the way as well. And that's part of the game that I play, is changing my own comfort zone. So
the problem with it is, in the first 10 years of investing, you feel like you're making no progress.
Yeah.
Like, all your progress is really dependent on how much capital you're contributing. Like, how much capital you're contributing to the holding costs of property or putting into a share portfolio. The returns are nothing in the first 10 years. And that's the numbers show that.
Yeah.
It's only after that 10-year period that things start. I mean, it depends on the numbers you're investing in, but it's only typically after that first 10 years that you really start to see the benefit of compounding. That's why experienced investors are much better through periods of volatility, because they've seen it all before. And that's why all the young investors or first-time investors probably make most of the mistakes. But that's okay. It's okay. Like, when you start out your journey, you're doing the right thing, even though you don't see the results yet.
Yeah.
And it's about having the confidence and knowing that that's the correct expectation, that it's not a signal you're doing anything wrong necessarily. It's just compounding hasn't kicked in yet.
Awesome. Now, I think it's important to start earlier, and even if you start small, those habits can build and compound as well. You don't leave it until you're too late. It's basically my very quick message to summarize that last point as well.
Yeah, well, because you need time. Starting early, puts you well in front. So if you wait till you're in your 40s, that's fine. You'll still have enough time to build wealth. But if you could start in your early 30s or even in your 20s, by the time you get to in your 40s, late 40s and 50s, you're going to be well ahead of most people, as long as you've done the other two parts of the formula right: investment efficiency and investing that regular cash flow.
Well, thank you so much for coming on and reminding us of these principles. It's good for me to reground myself in them as well, and turn away some of the shiny objects that I'll see in the next 6 months. Might have just saved yourself a few emails there.
No worries. Pleasure's been all mine.
No worries. Thanks, mate.
Just a reminder that the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.